why is there so much money on the sidelines? First of all, we haven't seen interest rates this high in 25 years. So what happens? I'll tell you what happens. I've got 500 clients. I'll tell you what happens. A client calls me up and says, Dom, interest rates at 5%. Should I buy a CD? Well, I said, no, buy a T-bill, because I can get a better rate than a CD. And I don't charge. As you guys know, I don't charge if you want to buy stuff that I don't manage, I don't charge. So if you're buying Amazon or you're buying a T-bill, it's just a service. If I'm not managing, I'm not charging a management fee. But anyway, a lot of clients have said to me, Dom, I'm going to send you 100 grand. Could you put it in a 5% T-bill? So yes, a lot of people saying, if I can get 5% with no risk. My brother, I was hanging out with my brother down in Florida a little bit ago. He goes, Dom, why should I be in the market? I can get 5% in a treasury. So that's a big part of why there's so much money in cash. People say, hey, no risk in a 5% instrument. I get that. Okay. But one thing you got to understand, and I've showed this slide before, there's a website called shadowstats.com. And you guys can Google it, it's shadowstats.com. And on the unpaid side, it tells you based on in 1980, based on how they calculated inflation, inflation today would be about 13%. They keep changing how they calculate the CPI. Now, why do they do that? Why do you think they do that? Anyone? What's tied to the CPI? Entitlement. Yeah, entitlement programs. So you think the government wants to pay 13% on Social Security kick up? No. So they keep changing the formula. They changed it twice since 1980. Under Reagan, then under Clinton. So they're telling me inflation right now is 3.8. I don't believe inflation is 3.8. I got some other bad news for everybody in this room. When they say inflation, it's the rate of inflation. So when those bananas that you bought or those eggs that you bought, prices aren't going down. They just ain't going up any faster. So if inflation goes to zero, the price of eggs is still going to be what it is today. The only way prices are coming down if we move into a recession and we have price destruction, which is worse than inflation. So prices are here to stay. That vehicle you want to buy, it's not going lower. It's maybe not going up as fast. And then when they say we're trying to cut down the rate of inflation, if it goes to 2%, that means from here it goes up another 2%. So people go, well, wait a minute, you mean prices aren't going to go back down to pre-COVID levels? Nope. Nope, you're bad luck on that. So why so much in cash? Okay, I talked about that, fear and uncertainty. You know, I teach a class at CU called Behavioral Finance and Hedge Funds. And how hedge funds, what a lot of hedge funds in Chicago do is they take a lot of human behavior, mass behavior, and they could game the market through, they can get alpha, they can get edge by looking at these behavioral effects. One of the effects is the snake bite effect. Now think about it, 23 was a good year, 22 was a disaster year. 22, the NASDAQ was down 30%. So coming into 23, a lot of people were snake bit. Market came up. Now people saying, well, interest rates are 5%, and market's probably overvalued. That's what the news is saying. So I'm just going to stay in cash. The other thing is interesting is, do I want to buy the market now at an all-time high? There's something called loss aversion. Do you realize it hurts twice as much to lose than to win? Let me say that again. It hurts twice as much. Professor, you probably know that. It hurts twice as much to lose than to win. So why that's important is people tend to sell their winners and hold on to their losers. That's a behavioral effect. And there's hedge funds that game that strategy. Because if you don't sell, you don't lose. So I'm not going to sell it. I don't want that pain. I'm telling my wife she's going to beat me. I don't want to do that. It's happening a lot these days. I understand. Okay, whatever. So there's also the herd mentality, the groupthink, that momentum effect. And the momentum effect, never underestimate the power of stupid people in large groups. So it's kind of interesting when you talk about, you know, what to do. What am I doing with my money? Should I be buying NVIDIA at 900? And is it going to go to 1,000? Do I sell it? Do I hedge it? Do I buy the market here? I've been in cash. I watched this market go up 20% last year. It's up 10% this year. Do I go up? Do I jump in now? Well, there is something called FOMO. fear of missing out. Fear of missing out is, boy, I gotta get on this train because everybody else is making money and I'm not. And it's a big behavioral effect. It's a psychological effect that I don't want to be missing out. And what happens is people start to jump into perceived safety and they go, okay, I don't want to be in a 5% T-bill because the market's up 20 plus 10, it's up 30 in the last year and a half, not quite. So where could you put me where I could still get better returns and feel so good about it? Investors might rush into popular investments that are perceived to be safe.